Hi there. Welcome to The Open here on BNN Bloomberg. I'm Lindsay Biscaya, and let's get to some of the stories we're following for you this morning in the BNN Bloomberg newsroom. U.S. President Donald Trump has signed a permit for a new cross-border oil pipeline, reviving elements of the canceled Keystone XL pipeline project. The Bridger pipeline will transport Canadian crude into Wyoming and clears a key regulatory hurdle. The move comes amid ongoing trade tensions between Canada and the U.S., with officials saying it supports North American energy security. Air Canada has suspended its full-year outlook, citing a surge in jet fuel prices linked to the Iran war. The company says the spike is creating a significant shock for the industry and testing travel demand. Air Canada added it will try to offset some of the cost pressures while also adjusting its route network. Air Canada reported its latest results yesterday after the bell. Revenue and adjusted earnings both came in above estimates. ExxonMobil beat expectations, meanwhile, despite disruptions from the Middle East conflict. Higher production in Guyana and the Permian Basin helped offset outages, while rising energy prices boosted earnings. The company warns, however, that ongoing instability could impact output guidance as key shipping routes remain uncertain. And we'll take a look at the U.S. futures this morning, about half an hour now till the opening bell. You can see the S&P 500 seeing further gains this morning in pre-market trading after Apple reported earnings. We're, of course, going to dig into that. It's boosting the S&P 500 up. The Dow also up this morning, and the NASDAQ future at the moment trading basically flat. And if we take a look at the TSX as well, we'll be watching that closely throughout the day to see if we can get any gains. Of course, markets opening about half an hour. The TSX closed just under 34,000 yesterday. This week was big tech earnings test. Meta, Alphabet, Amazon, Microsoft, and Apple all reported in a two-day stretch. Alphabet got the best response from investors, with the Google parent shares flying 10% higher on Thursday. Meta lost around 8.6% meanwhile. And this morning, the Apple stock is higher in pre-market after issuing a better-than-expected revenue forecast. So let's get more now from David Pettit, Director of U.S. Equity Strategy at Citi. It's great to have you join us this morning. Good morning.
Hey, good morning, Lindsay.
So if we're taking a look at the Magnificent Seven kind of as a whole at first, why do you feel as though the Mag 7 is no longer behaving as like a cohesive trading group? We're seeing some differences in terms of how each company seems to be traded, or how investors are viewing them, at least.
Yeah, people are getting a little pickier about the AI story when it comes to some of the names. And to be honest with you, none of them are really cheap. So when you have that setup, this whole talk about earnings and then the follow through, like you're talking about with Apple, that matters a lot more. When you look at the differentiation, it's really about who's beating and raising and whose long-term story isn't challenged. And to us, that's why you get really comfortable owning an NVIDIA, owning a Google, Amazon as well. And you start to question, I would say, Microsoft, Meta, Tesla, and so on.
So, Drew, then out of those Mag 7 companies, which ones do you think are kind of best positioned for return on investment as well as earnings compounding?
Look, NVIDIA's top of the heap here. Look, it's a relatively I would say asset light model, because it's more of a chip designer rather than a chip manufacturer. Tons and tons of demand. You've seen the estimates just continually blow out expectations and move higher and higher and higher. So I don't think there's any question there. And really, semiconductors are a bit of the choke point in the AI build out. Google, that's a compounder, but that's one where we're also starting to see the positive revision trend. Those are really our top two when we think about the Mag 7 and which ones you want to own and keep in portfolios.
On the flip side, then, do you think Microsoft will continue to be the most challenged of that group?
Yeah, and this really ties to the broader software space. Like, when you think about it, software has delivered good earnings. It actually has had upside to 2026 expectations, but that's not the concern. It's all in the terminal multiple. Like, are we looking at companies here that may be disrupted, or parts of their business that might be disrupted when you think about a Microsoft? Look, our analysts like some of the names. If you're going to bet on some names within software, Microsoft probably isn't a bad relative trade. there's some other names like Palantir or CrowdStrike that we like more around this cash return on investment thesis.
I wonder too, well, like when we're looking at some of the Mag 7 groups that are in the middle of this kind of list we're making here, when it comes to Meta, why do you think Meta is losing so much ground despite, relatively strong earnings report for its first quarter?
It's the guide. It's the forward expectations. Again, the estimates, it beat the estimates for this quarter, but when you look at the out quarter, they actually went down a little bit. So people are concerned about how much they're spending relative to how much they can make on that spending. So while the numbers are good near term, you don't have the confidence to continually lift the out quarter and out year numbers. I think that's why you're seeing a bit of chop here. This is still a name that we have in our recommended list and a name our analyst still likes. There's good engagement, but it's just working through this narrative short term.
What do you think the implications are of having roughly 50% of the S&P 500's value tied to future growth expectations, and why is that historically significant as well?
Yeah, it's funny. Thanks for bringing this up, because a lot of people want to talk about index valuation and PE terms. And look, that's all about today's E. When you think about a lot of the big names in the big trends like AI that are represented within the index, that's about future growth and expectations. And when you look at the S&P today and you break down where the value is coming from, most of that is not in current earnings. So it doesn't set a very high floor if AI ends up not being real. We're comfortable with that idea and with that theme, but it means when we get in these reporting periods, don't get hung up too much on the quarterly numbers. You got to listen a lot more to the long-term commentary for these companies.
Do you think investors are getting hung up, though, on these quarterly numbers at the moment or in the last couple of earnings reporting?
No, I think it's all about the out quarter and the commentary. You can see like big beats not really get rewarded if there's not follow through. So I would say investors, when you're thinking about this world where most of the value of the S&P isn't driven by today's earnings, you really do have to focus on the commentaries and the calls. That's where you get most of the volatility. So again, it's when we have these setups, it's not just about the quarter. It actually might be more about next year, the year after, in the long run.
Interesting. Just before we wrap up here, how would you describe Citi's investment strategy right now?
Look, we want companies that have good fundamental momentum. We like beat and raise stories, and we like these companies that can really improve on quality and efficiency. Okay.
We will leave it there. That is Drew Pettit, Director of U.S. Equity Strategy at Citi. Appreciate you joining us this morning. Thank you. Coming up, Canadian motorists from coast to coast are reaching to an overnight surge in gasoline prices across the country. We've got more on that coming up right after the break. Stay with us. Prices at the gas pumps are continuing to be unfriendly to Canadians' wallets as fuel prices rise another 8 cents on average today. Officials have said the suspension of Canada's fuel excise tax would likely save 10 cents per litre on regular gas and 4 cents per litre on diesel. But recent increases since its implementation haven't seemed to make an impact. So for more on this, we're joined by CTV's Scott Hurst. Scott, good morning. So pain at the pumps continues for drivers across Canada as we head into the weekend once again. Give us a glimpse of what it's looking like today.
Lindsay, good morning. It's hard to say it's a shock anymore, but that still doesn't take away the sting. And it really is a shared frustration for many drivers right across the country, as we're seeing on average, depending on where you are across the country, that there was a jump just overnight between 8 to 12 cents. If you look at some of the numbers here in cities across the country, Vancouver in particular, upwards of more than $2.20 per litre. So that is a significant jump in many cities. And as we've been saying, and we know by now, the war in Iran and the closure of the Strait of Hormuz costing the global economy billions, and fears of a prolonged conflict in Iran now driving prices toward record levels. And for Canadians, if the conflict isn't resolved in the weeks and months ahead, there's significant concern, and we've already started to see the beginning of this, the impact it could have on inflation. And so there's a lot of concern for Canadian drivers right now, and for many other things that we might have to purchase in the weeks and months ahead, Lindsay, that this will continue to impact us, not just filling up the gas tank, but in many other areas, and really hurt our own wallets.
Yeah, no kidding. And of course, the federal government's excise tax holiday on fuel, Scott, has been in effect for about 2 weeks now. What are experts saying about ways Canadians can try to save themselves a few bucks at the pump?
Yeah, there are tips to potentially save when you get to the gas pump, and these are things that we've all likely heard before, but often a good reminder as we're all looking to save as much as we can as we're continuing to see prices go up and up. And so one of the first bits of advice that's not too hard is to make sure that your tires are properly inflated. A survey last year found that only about a quarter of Canadian drivers check their tire pressure monthly, and according to CAA, underinflated tires can reduce your fuel efficiency by upwards of 4%. Also, unnecessary weight on your vehicle and in your vehicle, whether you're carrying something on the roof racks or significant weight in the back or in the trunk, that can be a drag, and that can make your car work harder and can increase fuel consumption. Also, how you drive, Lindsay, can be a drain on your bank account. Experts say to drive as evenly as possible, avoid hard accelerations or sudden braking whenever possible. Of course, might be difficult for us, particularly in the GTA, trying to deal with Toronto traffic, but a few little bits of advice to potentially save us a few cents, and then as it adds up over time, dollars at the gas tank.
Okay, some good tips there. That is CTV's Scott Hurst joining us live. Scott, thanks for that.
Thanks, Lindsay.
The New Brunswick RCMP is working on initiatives to educate more drivers on what vehicle modifications pass the road test and which ones don't. CTV's Laura Brown has more in this report.
It can't make contact with the body.
This is livery and onions, Andy McNeil's race car. He tows it to raceways. It's a little low to take on New Brunswick roads. The auto repair shop owner says customers do ask for these types of modifications.
If it's done properly, there's really no reason why they shouldn't be done.
This week, the New Brunswick RCMP is educating vehicle owners on what passes the road test and what doesn't, like tinting windows to the point an officer can't see if a driver has a weapon, or lowering or lifting so much it changes how a vehicle handles.
If you're bringing your center of gravity up, you may be making the vehicle more apt to tip.
In this province, if you're pulled over and an officer suspects a modification is unsafe, they can ask for an updated vehicle inspection or even an engineering certification. You can also be fined $172.50 for overly tinted windows. McNeil knows the vehicle inspection guide like a well-oiled machine. He can tell people what gets the go-ahead down to the dimensions of your fender.
There are some people who are interested in modifying the vehicle and don't know very much about it, and that's why I've approached the garage to do it. And then the other side of things, there's people who do know a lot about it, and that's why they've also approached the garage to do it, so it's done properly.
But there are some aftermarket accessories and parts that may not pass the test, including for your insurance.
You need to let your insurance company know in advance of getting those modifications done and paid for, because you want to know if your insurance is going to be impacted in any way.
Some have ridiculed the RCMP for shining a headlight on the topic, but this officer says part of their job is traffic safety.
Vehicles need to be safe if they're on New Brunswick roads.
Laura Brown, CTV News, Fredericton.
Coming up, Canadian Tire is launching a new venture today. We will find out what that is with our next guest right after this. Stay with us. Canadian Tire is launching its spring 2026 Hudson's Bay striped line in stores and online today. And here to talk about how this fits into the company's True North strategy and more is Bruce Winder, retail analyst and president of Bruce Winder Retail. Bruce, it's great to have you join us. Thanks so much.
Yeah, thanks for having me on, Lindsay.
Let's start with Canadian Tire's True North strategy. Tell us what it is and how does this new project tie into that strategy?
Yeah, it's a fairly new strategy. It's about a year old at Canadian Tire, and there's really three pillars to it. One is strengthening the core business. The other is deepening customer relationships. And of course, the final one is improving shareholder returns. So, in terms of True North, I think the Hudson's Bay collection is just an example of how the company, really knows their customer. They have a deeper relationship with their customer now. They've got all kinds of data from their Triangle Rewards partnership, and they also have the permission from Canadians to launch, this brand in Canada. So, and the other part of it is own brands too, right? This is an own brand. So Canadian Tire is different than a lot of other retailers. They actually own a number of brands like Sherwood and Raleigh and things of that nature. So this allows them to sort of further that one as well.
So what are some of the products we can expect?
Yeah, there's some really cool products. There's beach towels and totes and things like that, backyard furniture. There's some really cool Muskoka chairs, folding beach chairs, umbrella, backyard games, just a whole bunch of really cool stuff that you'd use at the cottage or in your backyard in Canada.
And we knew for a while now, there was talk that Canadian Tire wanted to take on these iconic stripes, right? But I wonder, why would this type of expansion be appealing for Canadians at this moment?
I think Canadians trust Canadian Tire, right? I mean, I think a lot of people were a little sad when Hudson's Bay went away, and they were looking for sort of a white knight to come in and pick up the brand. And like I mentioned, I think Canadians they give Canadian Tire that, credibility. They trust Canadian Tire. And not every retailer could have picked up the brand, but I think they've done a nice job so far, and I think Canadians have accepted the fact that, they offer this merchandise there.
Is there any chance or risk, I guess, of a brand stretch here? Like, obviously, these are two big Canadian companies, but they're known for quite different things.
Yeah, I don't think so. Canadian Tire is very cautious. Like I said, they use a lot of data and customer research from their Triangle Rewards program, and they're very careful about how much they extend the brand right now. They want to keep the credibility high. They want to be very selective about it. So I don't think there's a big risk with that right now.
If this works, do you expect Canadian Tire to kind of push more into soft home or lifestyle products? And also, who is the target customer for this new launch?
Yeah, I think the target customer is basically, Canadians with families, Canadians who spend time outdoors, who have a home, have a backyard. Yeah, I think, I think that they're going to continue on with this type of merchandise, but selectively over time. They're not going to, open up for 500 items in the next year. They're going to carefully see how customers react to it, use data, and really sort of expand as the customer gives them permission to do so.
Is there any kind of competition here for Canadian Tire? Like, I'm thinking of Giant Tiger's parent company, the Northwest Company, in terms of capitalizing on that space, that gap that the Hudson's Bay Company left behind.
Yeah, I mean, I don't think there's any risk. I mean, definitely it's an exclusive brand, so Canadian Tire has that. Depending on the commodity that the Bay sold, there could be other folks who sell some of that, make up some of that business in apparel and things of that nature. But when you look at the core HBC stripes, there's only one place to get that, and that's Canadian Tire.
And there's a lot of nostalgia attached to that too, right? Like, as you were mentioning off the top of our conversation, is this another nostalgia play? Like, we saw the revival of Zellers, for example. Could this be kind of a long-term success, or are you expecting it to be?
This is going to be a long-term successful venture for sure. There is a nostalgic play in it. I mean, definitely Canadians, you look at Hudson's Bay and the brand, and it's just incredibly nostalgic. It was been around for 400 years. So Canadians feel very close to this brand. It's not a flash in the pan. It's something that I think they can build into a fairly large business over time across their different banners.
For sure. Okay, we'll leave it there. Bruce Winder, retail analyst and president of Bruce Winder Retail. Always good to speak with you. Thanks so much.
Yeah, thanks, Lindsay. Take care.
Well, a new multinational bank based in Canada aims to fund defense firms with major loans and to boost growth. CTV's Judy Trin has more in this report.
As NATO nations ramp up to spend 5% of their GDP on defense by 2035, a new multinational bank with headquarters in Canada is being created to help smaller companies access loans to expand.
By pooling together, we're stronger financially, and it's a testament to Canada's reputation, Canada's commitment, Canada's financial expertise.
The Defence, Security and Resilience Bank could consist of 40 NATO nations and allies, all contributing to a funding pool of $135 billion US. It could employ 3,500 people.
Do you have in the Ottawa office?
This Ottawa technology company uses AI to help the Royal Canadian Navy analyze the moves of enemy ships. Anvil wants to expand to Europe and is hoping the multinational defense bank will open doors.
And can help guide, successful companies like ours through that path. I think that's a major benefit for Canada, and I'm very hopeful that the DSRB will be will be one of those conduits.
Where in Canada the defense bank will be located hasn't been determined, but the lobbying has already begun from Vancouver to Montreal to Toronto.
The right decision is here in Toronto. We have all the banks here, the financial sector here.
The national capital is also making a case.
The World Bank is in Washington. It's not in New York City. This is the place where defense innovation is happening.
At this point, there is no start date set for the new defense bank, and it's also unclear just how much each member nation, including Canada, will contribute to the pool of funds.
Okay, before the opening bells, let's take a look at the U.S. futures as we count down. You can see all U.S. futures trading up at the moment. The S&P 500 on track for another record high today, of course, as we're seeing all these big tech companies reporting earnings, boosting the S&P 500 up by 0.2% before the opening bells. If we take a look at the price of oil this morning, oil set for a weekly gain once again. This comes after Donald Trump said he was sticking with a naval blockade of Iranian ports. You can see oil currently up by more than 2% WTI to start the morning. The price of gold on the flip side dropping for that very same reason, with President Donald Trump talking about his plans for Iran. The price of gold down by 0.5% at about 4,600. If we take a look at the loonie, it's rising ever so slightly this morning after a bit of a busy week for data for Canada. We saw a lot of numbers coming out this week. The Canadian loonie compared to the US dollar is up ever so slightly. We're watching a couple of different companies today. I mentioned big tech stocks reporting earnings this week. We saw the Mag 7, a majority of them reporting earnings. Apple is one of those that we're watching closely because Apple reported earnings just yesterday. Shares are rising in the pre-market, up as much as 2.8% this morning. This comes after the iPhone maker gave an outlook for revenue growth that's stronger than expected. However, it also cautioned about the impact of higher prices for memory chips. So analysts are positive about these results and forecasts, and they praised the company about how it's navigating high costs of memory chips used in its smartphones, tablets, and laptops. And we'll take a very quick look at Bitcoin as well before we wrap things up here. Bitcoin trading above 78,000 at the moment, up 2.4%, ticking ever so higher after a bit of a drop at the beginning of this year. And stay with us. The opening bells are coming up next. We'll be right back. And here are the opening bells at the NASDAQ. Seaport Therapeutics is ringing the opening bell this morning. At the New York Stock Exchange, KKR & Co. rings the opening bell. And at the TSX, First Nations Major Projects Coalition is opening the markets. It's time now for the first 15. This is BNN Bloomberg trading day just getting underway this morning. So we will check in on the equity market. We'll take a look at the North American market, starting with the TSX. It saw quite a bounce back yesterday, but we're seeing the TSX losing some momentum today, ever so slightly, down at this point, 0.1% to open the morning. U.S. markets, S&P 500 up, of course, boosted by those big tech companies reporting earnings this week. The S&P 500 on a bit of a run, actually, right now. And the NASDAQ is up by 0.4%. And if we take a look at some Canadian companies we're following today, Air Canada is a big one because Air Canada is suspending its full year guidance because of the surge in jet fuel prices. This, of course, related to that ongoing conflict in the Middle East. The CEO of the airline says the sharp rise in prices since February has created a significant external shock for the industry. So that coming out today, Air Canada to start the morning down by more than a full percentage point. We're also watching TC Energy reporting first quarter earnings with an adjusted EPS above estimates on some strong Canada and U.S. operations. TC Energy down actually by 0.5% to start the morning. We'll continue to keep an eye on that stock throughout the day. And Black Diamond Group, watching this one too. This company's latest earnings also beat estimates, but it is down this morning more than 4%. So again, we'll continue to watch that one. And for movers south of the border, we are now joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, it's great to have you. Good morning. We'll start with Estée Lauder. This company is cutting 3,000 more jobs as the CEO is pushing an overhaul. What's happening here?
That's exactly right. Yes. So the company had previously said that it was going to cut 7,000 jobs, and now it is adding another 3,000 to that. So a total of 10,000 in total. This additional 3,000 job cuts the company expects will save it about $200 million. And this is part of a kind of a larger turnaround plan that Estée Lauder has embarked on. Wall Street so far is liking the plan, and investors are liking it too. Barclays was out with a note this morning saying that the 3,000 job cuts this morning do help kind of propel that turnaround plan forward, and it is helping propel the stock price forward so far this morning. This is the top performing stock in the S&P 500. Also worth noting that they did beat first quarter results and provide a better than expected earnings per share forecast for the full year. So that certainly helps too. So yeah, top performing stock in the market so far today, and definitely one worth watching because this is a very big move for it. 12%, given that size, is definitely worth watching today.
Yeah, a big move for sure. A lot of jobs cut, though. It's really interesting to see the reaction to that. Okay, you're also watching Western Digital. This company falling. Shares were down more than 4% before markets open. Tell us why.
Yeah, this is a stock that has been really on a very sharp run over the course of the month of April. This is a company that makes hardware and computer storage data. The entire group, the entire sector in this kind of memory chips and memory space has been on an absolute run so far in April. And so expectations coming into the quarterly results here for Western Digital were just so high, even though the company beat results, even though the company gave a forecast that it said its operating margin is expected to be 51 to 52%, which is an operating margin that most other companies would absolutely crawl over broken glass for. That's apparently not good enough for investors that have bid the stock up by 60% so far in April. So this is simply a case of you had good results, but the expectations were even higher than that. And so this is among the worst performing stocks in the S&P 500 today. Also worth noting that a handful of the peers in this group that have been rallying on the same kind of theme are also off today. So maybe investors got a little bit ahead of themselves bidding up those memory chip and memory adjacent companies over the course of the month.
Probably something else that would be interesting to keep an eye on. Okay, that's Bloomberg's Jeff Morgan joining us live. Jeff, thanks so much. Coming up, ExxonMobil has announced its first quarter results for 2026, and we'll tell you all about that right after this. Stay with us. ExxonMobil beat estimates for the first quarter of 2026, despite being impacted by the war in Iran. But profits fell dramatically when compared to the same period last year. So let's get more from Garnet Anderson, President and Head of the Portfolio Management Group at Tacita Capital. He joins us in studio. Great to have you.
Thanks for having me.
So I'm wondering what your takeaway then is of this latest earnings report from Exxon. Is it a positive one, do you think? Or if you're comparing it, I guess maybe not.
Well, it's a little bit hybrid. First of all, I think they did a good job. Management did a good job of really managing expectations. They came out last month and said, look, we've been impacted. We've had some production over about 6% of our global production has been impacted by the war in Iran. And that set expectations. And so we saw analysts do was they pivoted. They basically downgraded the Q1 earnings expectations, which Exxon went on then to beat, upgraded the Q2 expectations, which time will tell. And it's kind of funny. It's like for the accounting textbook folks out there, what is earnings per share in 2026? So when you take a look at pure GAAP, the purest form, well, they certainly underperformed because they basically booked about $4 billion of hedging losses. Now, they're pretty clear in their explanation that the hedging losses will reverse over coming quarters as those energy products are delivered. And it's not that they were doing anything speculative, they were just hedging their revenue lines. But right now, from an accounting perspective, that was about a $4 billion hit. So that drove down really, the pure EPS. On an adjusted basis, did well. Why? Because fracking spreads had widened out, so the refinery did well. Retail has not been hit. But that's not a massive needle mover for them. But they also didn't get the full, because they hedged so much of the future, they didn't get the full benefit of the higher energy prices that we saw really kind of March onward. But you would think for Q2, you'll see more of that kind of profit come to the top. But in the interim, you know what? They bought back a ton of shares. They issued a bunch of dividends. It shows where their interest is in terms of having returned a bunch of capital to investors. But it's different. That makes sense when oil's at 60. If they think oil's going to stay stickier, maybe not necessarily at 100 plus, then all of a sudden Venezuela goes from being uninvestable to, well, we'll go down there and take meetings and see if we can start to produce down there as well.
That's
it's a shifting story.
Right. I was going to ask you that because you say there's a chance here for Exxon to maybe expand, and Venezuela could be a good spot for them.
Well, it could be. I mean, yes, from a sheer production perspective. But in all honesty, it's like you're going from, they're not leaving the Middle East, but there's already a risky proposition there. I don't think Venezuela would be considered safe. I mean, they own about 70% of Imperial Oil, and they've got, our oil sands up in Alberta and other explorations. We're a lot safer of a network, a neighborhood sort of thing for them to produce. But it does open up an opportunity that was not there, and probably with some support of the U.S. government. Because you think politically, midterms coming up, U.S. wants to drive down fuel prices. What levers can they pull? So they're going to talk up that story in Venezuela, which Exxon might partake in. They're certainly one of the leading candidates there.
If you say Canada is kind of like a safer environment and area to be in, do you think we could see maybe a boost to the Canadian economy if Exxon takes note of that?
Well, yes. I mean, you have to be able to sell. And so obviously we export a lot of our energy down to the States. We obviously have our LNG new port kind of out on the West Coast. So yes, that should help staunch some of the decline in Canada's GDP, the higher energy exports. That is helping. But on the flip side, you have Canadian consumers and U.S. consumers, so on and so forth, that are suffering a little bit. They're still spending $1. It's just more of it is on energy than on other, discretion items.
There's a couple of other companies that we're watching for because they're releasing earnings soon.
Correct.
Aritzia, first off, on May 7th is the earnings release. What are you watching for with this company that's
well,
doing
I think
so well?
First, everybody talks Q1, Q2, Q3. You think that's, January 1st to March 31st. It's really to a March 1st quarter. So not really affected yet by any, consumers with their spending going towards energy sort of thing. So I don't think we'll see that. But is there going to be any messaging around, we're seeing in early, March and April that consumers are starting to pull back? Don't think so necessarily. It's too early for that for their consumer base. They're doing very well online. They're building up their footprint in the States. U.S. has higher growth than we do. And then the other thing is, while there's announcements of layoffs, you just mentioned one just now sort of thing. In North America, really the unemployment rates haven't spiked. You would think if they did spike, that can't be good for Aritzia. It's a semi-premium label, certainly upscale compared to many.
You mentioned also half of its revenue comes out of the U.S. So this could maybe benefit the company or benefit maybe some negotiations that we're looking at this summer.
Well, exactly. It was to come down Kuzma sort of thing. It's a little bit of a natural hedge. So I think for a Canadian investor looking for kind of a North American retail play, that certainly would help from a Canada to U.S. They have been repivoting in terms of where they're pulling in their goods, both into Canada and U.S. for production. And they, as they retooled that, they talked about that kind of at the end of last year, that they had to rejig some of where they're pulling their materials from. I think some of the messaging for this quarterly report coming up will be what furtherance of their retooling in terms of their inputs have they undertaken. But fundamentally, they're growing in the States. It's a better economy down there, but there are constrictions coming into the credit market in terms of student debt and what have you. So too early, I think, for it to dampen Q1, but it is priced, I don't want to say for perfection. because they've done a great job,
Yeah.
but it is priced at a hefty premium.
Interesting. Okay, the other one you're watching for, Brookfield Asset Management, May 8th, I believe, is the earnings release for this company. What exactly will you be looking for?
Well, it will come down largely to what new capital raising that they do, what new fee revenue is coming in, what distributable earnings are coming in. It kind of came off last quarter, is on a good slope from that perspective. And then the only, I wouldn't say the only, but one of the flies in the ointment and why it's off about 23%, part of the reason is, private credit right now, some of the shines come off of that, a lot of questions, how much of that's about software and the true underlying credit quality. They have good credit managers. So you never know till the tide goes out who's wearing the bathing suit. But if their credit managers are good and the tide goes out on private credit, ideally they can make some hay and they can actually become opportunistic about it. But that is down the horizon. Right now, I think as long as they keep on growing, it's a great entry point. A foreign investor doesn't have that position. It's a global, it's got a global footprint, Canadian dividend or Canadian tax treatment of dividend. So it's nice of both words, and it just has leverage to the upside for the patient investor.
And you feel also like with the AI threat that we've seen playing out on some software companies, you feel like Brookfield Asset Management has some protection against that?
They've got so many lines of businesses. Yeah. Yes, they've got data center exposure, and initially through their credit, they've got some software exposure, but last call they talked about, it's really less than 1% of their book. But between real estate, that's starting to come back, between infrastructure, that's all in vogue, between private equity, that dips and valleys, but is growing, and private credit, they've got good expectations for. And they've got the connected companies they earn money on, and then they've got the insurance that they earn money on in terms of fees. It is a safe basket, all things considered. And it does come down to management. Can they recycle capital? Can they walk with those returns, earn those carried interest, and then things will take care over time? So is it a quarter by quarter stock? No. But is it off? So a decent entry point for part of somebody's position? Certainly wouldn't be selling at this point.
Okay. We're out of time, so we will leave it there. But so good to have you come in. Thanks so much.
Thank you.
Appreciate it. That is Gernot Anderson, President and Head of the Portfolio Management Group at Tecina Capital. Okay, stay with us. Well, actually, we'll tell you about yesterday on Market Call first. We were joined by Brianne Gardner, Portfolio Manager and Senior Wealth Manager of Velocity Investment Partners at Raymond James. Her focus was North American large caps, and her top picks were Barrick Mining, General Electric, and Visa. Joining us today on Market Call is Barry Schwartz, President and CIO of Baskin Wealth Management, and his focus is North American large caps. Just ahead, more on U.S. President Donald Trump issuing a permit for a new cross-border oil pipeline to transport Canadian crude into Wyoming. Details coming up next. Late yesterday, U.S. President Donald Trump signed an order authorizing a proposed Bridger pipeline project to transport Canadian crude oil from the Canada-U.S. border to Wyoming. So for more on this, we are joined by CTV's Jeremy Chiron. Jeremy, good morning. This order is partially reviving parts of the Keystone XL pipeline plan. What do we know about this proposal so far?
Yeah, good morning, Lindsay. Look, many people may be looking at this and thinking, wow, this looks familiar, sounds familiar. And to your point, it's because many aspects of this proposed project are reviving, quite literally, existing infrastructure from Keystone XL, especially when you look at the Canadian side of the border and the Canadian side of this project. South Bow would be the potential company working alongside a Bridger pipeline here. South Bow is in the early stages of looking at a prairie connector that would allow, the revival of some existing infrastructure on the Canadian side through the prairies to get that crude to this connecting point at the U.S.-Canada border where the Bridger pipeline would begin. You're looking there at the red part, which would be the new proposed pipeline, versus the old proposed and canceled Keystone XL. And so on the U.S. side is where you see the biggest differences. The pipeline would now end in Wyoming, would only go through 2 states, and will avoid a lot of controversial areas, and will actually follow for the most part, routes where pipelines already exist. And so the idea here is there would be less pushback from Indigenous groups because these pipelines would not be crossing through any contested territories, and would be avoiding some of the most controversial environmental pushback. So the idea from Bridger here is that this is a lot more likely to happen, and they believe because of the existing infrastructure that exists on both sides of the border that will be utilized here, they can get this done pretty quickly. Their timeline is to start construction in 2027 and be completed by 2029. Sounds ambitious. It's an idea for now. It's in the early stages, but a presidential approval here certainly makes it more likely. The big question is whether or not we'll see continued progress and buy-in from South Bow on the Canadian side.
It's really interesting, too, from a political standpoint, to see the White House authorizing this proposal. Like, it feels like a bit of warming of tensions between the U.S. and Canada. Where is Canada's relationship with the U.S. currently, and where is it heading? Where does this authorization kind of fit in, do you think?
Yeah, I mean, to your point, Lindsay, you look at what U.S. President Donald Trump has said in the past, which simply, he has repeated that the U.S. doesn't need our energy products, that they do not need to rely on our crude, despite the fact Canada was the single biggest exporter of crude to the U.S. in 2025 and has been for a long time. More than 1.6 billion barrels of crude moved from from Canada to the U.S. In 2025. So this is maybe an acknowledgement that actually the U.S. does rely on our crude and on our energy products. In fact, they want more of it. This would increase our exports by 12%. So that element alone is kind of interesting. And then when you look at the fact that Canada has actually been trying to diversify its export markets, there are questions about whether or not there would be interest even on the Canadian side. There's talk about a potential pipeline to the West Coast, this MOU between Alberta and Ottawa. Would there be capacity to build both of these projects and fill both of these proposed pipeline expansions? Experts will weigh in. Some have different opinions on that. But certainly it is interesting to see a project like this get greenlit by the president that relies on Canadian crude and increases the U.S.'s reliance on our crude, and the potential impact that has on, to your point, the tension that exists when it comes to trade between the two countries. As we go into a CUSMA review, does this play a role in those negotiations? Maybe it helps Canada in those negotiations. All of those things are realities that we could see make sense down the line. So a lot of big questions here and the impact this could have.
Yeah, for sure. Okay, we'll have to leave it there. That is CTV's Jeremy Sharon joining us live. Jeremy, thanks so much for that. Coming up, 5 software stocks that AI might not be able to replace. We'll dive into those right after this. Stay with us. Even with U.S. markets at record highs, a lot of software stocks are struggling. And that's because investors are worried AI is disrupting their business. Despite those fears, one analyst says some software companies are set to succeed in the AI era. BNN Bloomberg contributor John Ehrlichman joins us with that story. John, good morning. John, of course, hosts the Ticker Take investing channel on YouTube. And so, John, this is a view from the investing team at Citi. Is that correct?
It is, Lindsay. Yeah, Fatima Boulani, who is actually a regular guest on BNN. I think she's one of the better software analysts on Wall Street, and our conversation proved why, because you're absolutely right. Generally, investors have been in a pretty good mood, and they have been buying tech stocks, but there's this one group, sometimes they call them the SaaS stocks, software as a service, that are really struggling to win over investors when every day people are using more AI tools and asking the question, will people be willing to pay for the software services, and that includes businesses, that they once paid for going forward? And investors, for the most part, aren't sure. And that's why all the analysts are trying to figure out which companies out there could not just survive, but thrive. And for Boulani, it's really about the plumbing. Now, bear with me here for a second. Basically, you've got layers of software that live on top of everything else. And there is a worry that a lot of those kinds of companies companies could be disrupted and already have been disrupted. But she makes the argument, especially for people who are selling into businesses, companies that are selling to the enterprise, that the layers below the surface, where you've got a lot of integration with the rest of the company, that is hard to replace, especially when those companies can make a case that what they are doing is actually going to be more needed, not less, because of AI, things like cybersecurity threats.
Okay, so what are some examples of stocks that Citi thinks will not only survive, but potentially thrive in this AI era then?
Yeah, so the first thing to do is to look at all the pure play cybersecurity companies out there. Two of the biggest ones are Palo Alto Networks and CrowdStrike. They get talked a lot about on BNN, but for good reason, because these companies are very dynamic and have been evolving their own business. Even if you look at the projections for growth in their businesses over the next 5 years, it's quite impressive. Most analysts on Wall Street like those names, and she does too. And then there are companies that have cybersecurity and a lot more that fits into that plumbing narrative that we were talking about. A great example would be Cloudflare. NET is the symbol there, actually co-founded by a very savvy Canadian. Cybersecurity is just one part of what they do, but they are very much a company that will be seen as a partner to the enterprise as AI evolves. We do have 5 in total. It's on the website today. But I think investors are really going to have to figure out which way they want to go as AI disrupts. And within software, this is one of the hottest conversations right now on Wall Street.
Okay, we will leave it there. John, appreciate your time. Thanks so much. And you can find the full list of stocks in John's story on our website, and you can check out Ticker Take on YouTube and all podcast platforms. Coming up, the S&P 500 is near record highs this morning, which our next guest says is odd considering oil prices are above $100 a barrel. More on that with Jamie Murray after the break. Stay with us. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. U.S. President Donald Trump has signed a permit for a new cross-border oil pipeline, reviving elements of the canceled Keystone XL pipeline project. The Bridger pipeline will transport Canadian crude into Wyoming and clears a key regulatory hurdle. The move comes amid ongoing trade tensions between Canada and the U.S., with officials saying it supports North American energy security. Shares of Air Canada are moving lower today. The airline has suspended its full-year outlook, citing a surge in jet fuel prices linked to the Iran war. The company says the spike is creating a significant shock for the industry and testing travel demand. Air Canada also reported profit and revenue in its latest quarter that came in ahead of expectations. And we're watching shares of TC Energy today. The Canadian energy company has approved a $1.5 billion pipeline expansion project. That move will expand its Columbia gas system that extends from New York to the Midwest and Southeast. It's expected to be in service in 2030. TC also reported results for its latest quarter, where it saw a decline in earnings from its Canadian and U.S. pipeline operations and missed on revenue. And we'll take a look at the TSX this morning, down to start the day ever so slightly, basically unchanged actually at this point after seeing a pretty significant bump of more than 600 points yesterday to end the day. If we take a look at U.S. markets, bit of mixed trading earlier today, now all trading up at the moment. The NASDAQ up by more than a full percentage point. The S&P 500 also on track for another run today as we see those big tech stocks that have reported earnings this week kind of bumping up the S&P 500. And as I just mentioned, the S&P is now in record territory this morning once again, driven by strong mega cap tech earnings this week. Our next guest says it's odd to see the market hitting new highs with oil prices above $100 a barrel. Let's get more now from Jamie Murray, president of the Murray Wealth Group. It's great to have you join us. Thanks so much. Good morning.
Thanks for having me.
So given these high oil prices that we're seeing, why do you think we're seeing kind of record high markets, specifically with the S&P 500?
Yeah, and I think my comment was sort of just a sanity check with oil prices over 100. You wouldn't think the market would be rallying to new highs. But then when you look beneath the surface, we're actually seeing earnings estimates for the S&P 500 index start to accelerate higher. Now, Some of that is energy companies obviously making higher profits, but those profits are obviously coming out of the pockets of other companies. So really, where is the the earnings moving? I think you alluded to the big tech. We're seeing the memory companies like the Microns and SanDisk see very, very strong profit growth, and their customers are the hyperscalers, the Googles, Metas, Microsofts, and they're seeing strong demand. So they're able to absorb those price increases from those companies and still pass them on. As well, other sectors that aren't really affected by oil prices, like healthcare, we've seen United Health, big index constituent, one of our holdings, have a big move up as well. And so I think the real takeaway is that the world economy is a lot less sensitive to oil prices as it used to be even 10, 15 years ago, like going back to 2008 when we saw that price shock. Now it still has an effect, but it's really going to be more the things that are directly have oil as an input, like we're seeing the travel industry, for example, be affected by the oil prices.
So then do you think the record high market valuations that we're seeing right now are sustainable with all of those factors involved?
Yeah, we do. We think the market's going to continue to grind higher. Now, obviously, this is assuming a consistent oil price to what we've seen in the last month or two, around the $90 to $100 US. Certainly, if we move up into a certain huge supply shock, seeing prices $150, $200 a barrel, that's going to change the equation. But we think we can continue to move higher. And again, just those sectors that aren't really seeing oil as an input into their operations, that's what's driving the market higher, and that can continue in our eyes.
Obviously, it's earnings season right now, but the kind of results we're seeing show results from mostly before the conflict in Iran began. With that in mind, do you expect to see weaker earnings next quarter, especially as we start to see the high oil prices kind of weigh in?
In some cases, like I know we might talk about Air Canada coming up, and they reported last night, and they're seeing the oil price certainly affect their operations. That's going to have a bigger impact on Q2. And I think the market is generally looking at this conflict as sort of the next 60 to 90 days. That's where we're going to focus. And everything still seems like it's all clear for the next 60 to 90 days. But it's really so we might see some pressure in earnings, but the market's looking through that into the back half of the year and into 2027. But what is really the risk is if this does persist and continue to drag on and we see higher prices get passed on, we start to see inflation pick up, we might have to see the Fed with the new chair who's talking about cutting rates actually move to more neutral or even raising rates, particularly if we start to see the oil price flow through into the general economy and create a higher level of inflation broadly.
Mm-hmm. Okay, so I was going to ask you about a couple of different stocks. So we'll start with Air Canada because you mentioned that already. It's down 1.7% at the moment. With the news coming out today from Air Canada, is now a good time to buy, or would you be kind of wary of this stock right now?
Yeah, so we own Air Canada in our Global Equity Growth Fund. We've owned it for a long time. We're still believers in the cash flow inflection that we think is going to come in 2027, 2028, 2029, where this company potentially could generate $1 to $2 billion of free cash flow a year, and it has a market cap of around $6 to $7 billion, depending where it's trading on any given day. So a very nice capital return profile we think is setting up for Air Canada over the long term. Now, having said that, they did have suspend the full year guidance, again, due to oil prices. And it really came down to, I think, Air Canada saying, we don't know where the oil price is going to be in June and July and October, November, December. So we're going to pull our guidance for that time period because hypothetically, if the conflict ends in the next month, 2 months, we could actually see oil prices move lower, and that's going to be positive for the stock. If we see oil prices persist and stay higher, we're going to have to see how consumers respond to demand or higher prices and how demand shapes up. Now, so far, they aren't really seeing any demand degradation, so that's positive. They had really, really strong Q1 results for the January and February before the conflict started. So it's really going to be the shape of oil prices and the shape of demand that's going to drive the stock higher. But we think if you can look out to 2028, 2029, this could be a $40 stock when you get to those years.
Okay, I want to ask you about Meta next. This company down about 8% since they posted their earnings. It's rebounding ever so slightly at the moment. It's up and down, actually. But you see this as a good catch-up trade. What do you mean by that? You think there's some opportunity for Meta in the future?
Yeah, definitely. So we really like the whole AI hyperscaler universe. That would be the Amazons, the Microsofts, Google, Meta as well. And Meta's sort of been left behind in the last month. I mean, Microsoft as well to some degree, but Meta has the fastest revenue growth out of these companies. Actually grew revenue 33% in the quarter they just reported. That's the fastest growth in 5 years for this company on a much, much larger revenue base. And so we think it's clear that AI is benefiting Meta. They're doubling down on that investment. So that's why the stock was down. Investors didn't really like that they increased their CapEx to spend more on AI. But from our seat, it's working. This is a company that used to be advertising-wise about half the size of Google. It's now almost caught up to Alphabet Google in terms of its advertising business. And we're starting to see some green shoots in some of these other projects that they have. So not just Facebook and Instagram, their big social media platforms. We're starting to see the Ray-Ban glasses adoption really start to accelerate. We're seeing WhatsApp, the big messaging app, start to monetize around the world. So there are some new growth levers that are growing very quickly, probably 50, 60% underneath the hood. Now they're small, but these are going to be long-term contributors. And so with the stock trading at 21 times, where you see Amazon and Alphabet trading closer to 28, 29 times, we think there's a good catch-up trade here for Meta over the next 6 months.
Okay, that's all the time we have, so we'll leave it there. Jamie Murray, president of the Murray Wealth Group, appreciate your time. Thanks so much.
Thanks for having me.
Coming up, shares of Agnico Eagle are lower today, despite the gold miner reporting a beat on revenue and adjusted profit in the latest quarter. So we will talk to the CEO of that company coming up. Shares of Agnico Eagle Mines are slightly lower despite reporting a beat in revenue. The Toronto-based company maintained guidance for the year. Joining us now is Ammar Al-Jundi, president and CEO of Agnico Eagle Mines. It's great to have you join us. Thanks so much.
Nice to be here, Lindsay.
So you reiterated guidance this time around. Why did you make that decision? Why not raise it?
Well, it's early in the year. It's the first quarter of the year. We had a solid production, very good cost control, and it just seemed the prudent thing to reiterate guidance.
Is there any geopolitical kind of conflicts around the world that kind of are stopping you from maybe raising guidance this early in the year? Is there some uncertainty that you're seeing later in the year?
No, we look at our business very proactively. Of course, the obvious question is going to be, oil price sensitivity. We manage that very well. We have materially less oil price sensitivity versus most of our peers, both structurally how we operate and some proactive things that we've done. But other than that, Lindsay, the business is going quite well, and we don't anticipate major issues. And to your question, really, that's why we wanted to go out and reiterate to our owners that things are going well and our guidance is still sound.
For sure. You also return meaningful capital to shareholders this quarter. How did you kind of weigh that decision against any growth buybacks?
Well, we're generating an awful lot of cash in this gold price environment, like our peers. The first thing we do is we pay our dividend. We've paid a dividend every quarter for 43 years. That's pretty good for a cyclical company. We are investing heavily into our business. We invested over $400 million in growth projects. Lindsay, we expect to grow the business by about 20 to 30% over the next decade. Again, I think the best growth profile in the industry. We made a big tax payment to the government of Canada. And we were still able to increase our cash position to over $3 billion.
Which of your projects are really going to be fueling a lot of that growth that you say you're expecting to see? Is there any one particular one that you have high hopes for?
Well, we have high hopes for a handful of them. Let me go through. Detour mine, we think we're going to be able to get that to producing over 1 million ounces a year for decades. Malartic, we think we're going to be able to get that to over 1 million ounces a year for decades. We are going to be bringing people up to Hope Bay in the Canadian Arctic to talk about, a likely go-ahead decision in May. That'll be over 400,000 ounces a year. Again, we think for decades, and we're building Upper Beaver. Now, very quickly, in the entire world, there's maybe only 3 mines producing 1 million ounces a year, only one in the Western world. So we expect by the early 2030s between Detour and Malartic to have two of only three mines in the Western world producing over 1 million ounces a year. That says something.
I wanted to ask about the Finnish acquisition as well, because Finland's obviously a bigger part of the story now with the proposed consolidation in central Lapland. What advantages does this new region kind of offer Agnico Eagle?
Well, you know, we've been there for over 20 years with our Kittilä mine, which is 50 kilometers away. So what Agnico has done for almost 70 years successfully is we go to regions where there's a lot of geologic potential and with political stability. We try to consolidate land. We try to build a competitive advantage. And what this does by giving us this additional 2,500 square kilometers of what our team thinks is the most prospective land for minerals in all of Northern Europe, this allows us to take the same strategy that's worked for us for 70 years into Finland, which is get the best land positions in the best districts in the safest parts of the world, build a competitive advantage, and go from there.
Is there a timeline for this project? Like, when do you expect permitting to start?
Well, that's a very good question. It's a big land package. We're going to focus, though, initially on the Ikara project. And what we want to do first, Lindsay, is freeze the project so that we can actually start the permitting. And the permitting will take a few years.
Gold prices obviously remain slightly elevated. They're down today, but with geopolitical macro uncertainty, we're seeing a bit of a roller coaster with gold prices for the start of this year. How do you think about planning the business around these prices, or do you at all?
Well, we do. We have to, we are in a cyclical business. So what we do is if you are us, what do you do in a cyclical business? You focus on generating a lot of cash. You have a very strong balance sheet. We've got over $3 billion of cash and under $200 million of debt. So strong balance sheet. We're the lowest cost of the senior producers. We operate in safe jurisdictions. I think there's no other senior gold mining company in the world that is as well positioned as Agnico Eagle, not just for increases in gold prices, but also for potential decreases.
Your company also recently published a sustainability report. Can you give us some of the key points to consider from that?
Well, I think the key points is that sustainability isn't just words. It is environment. It is communities. It's First Nations, and our strategy again is to go into regions and stay there for decades. So by definition, our business has to be sustainable, and I think our team really is ahead of everyone else when it comes to the sustainability report we just published.
And just lastly, we've seen a lot of your peers kind of look south of the border for listings, Capital Access, Barrick Mining, for example. How do you think about listing geography and access to capital? And does Agnico feel well served by the Canadian market at this time?
We are extremely well served by the Canadian market, and we have access to investors in the United States and around the world. We're very happy with our position, and we don't see any chance of changing that anytime soon.
Okay, we'll leave it there. Ammar Al-Jundi, President and CEO of Agnico Eagle Mines. Great to have you on the show again. Thanks so much.
Thank you. My pleasure.
Coming up, Air Canada pulled its guidance for 2026 as jet fuel prices remain volatile and the conflict in Iran continues. We've got more on that coming up next. We are watching shares of Air Canada today after the Montreal-based company pulled its guidance for 2026 as jet fuel prices going forward remain uncertain. Here to break down the results for us is Tom Fitzgerald, analyst at TD Cowen. Great to have you join us. Thanks so much.
Thanks for having me.
So without this guidance now, how are you incorporating uncertainty around geopolitical risk and jet fuel prices moving forward, particularly for Air Canada?
Yeah, it's a great question. This is going to be a really fluid year, I think, for consensus airline estimates, likely moving around, week to week, month to month, depending on how the fuel curve swings. I think the important thing for investors to focus on here, though, is how strong the revenue outlook was. the last year or so, unit revenues have been lagging the growth in unit costs, but they're growing unit revenues high single digits year over year now. They're exceeding the growth in unit cost, which should start to bend down as we move towards the second half of the year, and especially 2027 and 2028 as they take delivery of more fuel efficient and just more overall margin efficient, margin accretive aircraft. So I think the shares are looking fairly attractive for long-term investors here.
We're also seeing Air Canada temporarily halting flights to JFK from Toronto and Montreal. How would you assess the financial implications of a move like that?
Yeah, I wouldn't read anything overly concerning into that. You think about the New York area, they have connectivity into Newark Airport as well as LaGuardia. So as they go through this, they're evaluating, where they maybe have room to cut. And they talked last night on the call about trimming routes where maybe they had frequencies to spare. So I think if you think about a market like New York City where there's 3 airports, I wouldn't be overly concerned about trimming into the JFK route.
Okay, and I think you mentioned this too, like the bright spot for the company in this latest earnings report was the beat on revenue estimates. What do you think is driving that?
The diversity of their network. I mean, they're seeing really good strength across the Atlantic, over the Pacific, and encouragingly in Latin sun markets. There was some investor concern this year about whether they'd be able to pivot sun markets from the U.S., like Florida and Arizona, into near Latin, Mexico, and the Caribbean. And they were growing Latin capacity around 20% year over year. And they were still able to grow unit revenues in the Latin market around 5% year over year, which is pretty impressive on that type of capacity growth. And it's not just Canadians going to the sun markets to escape the winter. They've for a long time, they've been building up their Sixth Freedom traffic, whether connecting Americans trying to go to Europe or Asia, but now also increasingly folks in Latin America trying to travel to Asia and Europe. And that's, I think that's an exciting new growth vector for the company.
Although we're seeing these higher jet fuel prices, Air Canada is expecting a slight increase in capacity in the second quarter. Why is that? What do you think?
Well, they're only increasing capacity about 0.5 to 1% year over year, so that's essentially flat year over year. And the third quarter, maybe we see a little bit elevated growth on a year over year basis, but they're also going to be lapping the impact of last year's flight attendant strike, which depressed the base effect for the ASMs. So I don't think, I wouldn't view their capacity as overly aggressive in this environment. And again, they talked last night taking things 2 months at a time. So they seem pretty comfortable with how demand's holding up and where the fuel curve is right now. And I think they're adjusted accordingly. Maybe we see a little bit more pulled out in the back half of the year. But again, like we noted earlier, it's going to be a fluid environment.
Yeah, for sure. And in the short term, management did say it expects to offset 50 to 60% of incremental fuel expenses through, quote, various commercial and cost actions. What specific actions do you expect or do you think we'll see from Air Canada?
I think it's just as simple as pushing fares higher, maybe trimming some of the redundant capacity at the margin. And that should also add a higher floor. There was some concern that maybe given their competitors have different fuel hedging strategies, we might not see as much uniform pricing increases as we've had in the U.S., but that doesn't seem to be the case. It seems like they're operating against a pretty rational pricing environment, and their peers, no one's really cheating or pricing irrationally here, which is encouraging to see.
And obviously, this company has been in the news quite a bit recently. It took a bit of a PR hit with its CEO, Michael Rousseau, who is expected to retire at the end of the third quarter. How do you expect the direction of this airline to kind of change, or do you expect it to change with the latest CEO exiting?
I don't think anyone's expecting drastic changes. I mean, I think the long-term plan in terms of their fleet and how they want to run the network and how they want to lean into their geographic diversity and their ability as the role that they can play as a super connector. I think that's all intact. I mean, obviously at the margin, any leadership changes, there can be different shades of gray, but I'm not expecting any drastic overhaul.
Especially when it comes to these higher jet fuel prices and trying to manage that, like you don't think there's going to be a drastic change in direction with a new CEO?
Well, I think it depends on, if we see fuel normalization over the back half of the year and demand holds in and people are still feeling constructive on the macro as we look towards 2027, I think you'd see one strategy. I think if fuel stabilizes and if we see elevated fuel in the current range or higher, and God forbid if demand starts to crack or we saw a downturn in the macro, I think then you adjust accordingly. Maybe you either delay CapEx or you pull back on your growth plans. But I don't think you can just call it here and say this is what we're doing. I think you really have to be nimble on your feet and quick to adapt where the puck is going.
Now, your price target for Air Canada is set at $21. What do you think will bring the stock to that price over the next year?
Yeah, I mean, I think they just have to continue executing, and we need to see signs that they are indeed bending the cost curve down, or they're on a path to bending the cost curve down as we move into 2027. Demand is still hanging in, and investors can get confidence that there's going to be an upward revision path for EBITDA margins.
Okay, we will leave it there. Tom Fitzgerald, analyst at TD Cowen. Appreciate you coming on. Thanks so much. Coming up, Apple is rallying after an upbeat guidance, but there are still big questions around supply constraints, costs, and what comes next for the company in AI. Our next guest will break all of that down for you. Stay with us. Apple shares are on the rise today after forecasting a stronger than expected revenue for its current quarter. The company also delivered a solid earnings beat driven by strong demand for its latest iPhone lineup. However, despite the strong results, some investors have concerns about rising costs, supply constraints, and how Apple is positioning itself in the race for AI. So joining us now to break all of this down is Mark Newman, Managing Director and Senior Analyst at Bernstein. It's great to have you join us.
Morning. Thanks for having me.
Yeah, so Apple forecasting a 14 to 17% growth next quarter, well above expectations. What do you make of that forecast?
Yeah, I mean, obviously, iPhone is the big driver here. And the last 2 quarters, Apple's got over 20% year-on-year growth from iPhone, just phenomenal growth. MacBooks also helping a lot. MacBooks have been sold out. They're having supply constraints on MacBooks, but still, sales up a lot and expected to continue to grow. So what's happening, I see, is there's a lot of memory constraints and memory price inflation, and there's also supply constraints in CPUs as well. But Apple is best positioned to weather this storm because they have the best supply chain relationships out there. This is what Tim Cook is known for being the supply chain management guy. This is what he's done before. And so they get better access to parts, but also they're going to be getting better prices than competitors as well. So in this kind of environment, they are gaining share. That is what's happening. We're seeing that the smartphone market and the PC market is shrinking this year, but Apple is still growing, and they're growing really across the board, particularly in the mid kind of price points where their competitors are really short of parts.
And I'm just seeing now Apple's seeing its biggest gain today since August. So it's doing pretty well since this latest earnings report came out, as you just mentioned. You mentioned MacBooks, but also iPhone sales drove a lot of that revenue strength. Can investors expect that momentum to continue?
Well, I think the implied guidance must mean that the iPhone revenue growth continues at a fairly similar rate, maybe a touch lighter, but it has to be still very, very strong. Otherwise, you can't get to that 14 to 17% year-on-year growth. iPhone is still by far the biggest driver of revenue. So that has to do well. That has to be inferred in this. And again, I think that has to be across the board, even within iPhones, including lower-end price points, including the 17e, for example, the newly introduced lower price point or more budget price phone, and even the 16e is still on sale. We've seen across the world. So those are really helping. The very, very wide price points, all the way from the very high-end 17 Pro Max with 2 terabytes, $2,000 to the $599 iPhone 17e.
On the flip side, though, we're hearing a warning coming from Apple about rising memory chip costs. What do you make of that warning, and how much do you think this might affect margins for the company going forward?
Yeah, so they did guide margins down about 130 basis points, a 1.3% decline in the midpoint for the June quarter. And they called out that the main reason for that is rising memory prices. And they also said that in the September quarter, there's going to be more headwinds from memory. So I think that's going to happen. I think that is expected, and being baked in numbers, that margin will come down as memory price goes up. But the flip side is if maybe price goes up a lot, they're probably going to increase the prices as well for the iPhone 18. So your iPhone's probably going to be a bit more expensive next in September. And so that's going to help alleviate some of these memory cost inflation impact. And also it can also help the top line growth as well.
There's also questions about Apple's position in artificial intelligence. How would you describe where the company stands today, especially among its peers?
Yeah, so I think Apple has been quite late with their Apple Intelligence. You know, what they promised that they would release over 2 years ago, they released a few things, but really the main things that they teased us about like 2.5, 3 years ago have not really come out yet. So they're late. And I think that expectations are fairly low at this point from investors. And I think that therefore the risk reward is pretty much skewed to the upside, that if they can come up with something meaningful this year, meaningful improvement to Siri and Apple Intelligence, I think shares will rally on that. That's what I'm excited for. I think this is really what's going to drive the stock second half of this year is what do they do with Apple Intelligence and Siri 2.0? They have promised, yesterday they promised that there will be an update this year. So we're just waiting to see what that is. And yeah, we think that could drive some optimism and further stock price rally from that.
We're also heading into a major leadership transition. Of course, what expectations should investors have for John Ternus kind of taking the wheel moving forward?
Yeah, so John Ternus, he had a surprise entrance to the earnings call last night, came in. I think it's great to hear his voice and introduce himself. I mean, his background is product innovation. So you know, he's been running the most important part of the company for the last 10 years or so: iPhones, iPads, Macs, wearables, etc. So you know, I think he's a real safe pair of hands here. I think there's some potential chance that being from a product innovation background, that there may be a bit more emphasis on product innovation, a bit more faster innovation, perhaps on products. Maybe we'll see some smart glasses soon. You know, that's the hope. But I think apart from that, it's going to be pretty much steady as she goes. Tim Cook is not going anywhere. He's stepping up to the executive chairman seat. So he'll still be around giving advice. So I don't think there's going to be any major change in strategy from the company.
Got it. Okay, so much to talk about. Well, we'll have to leave it there. Mark Newman, Managing Director and Senior Analyst at Bernstein. Always appreciate your time. Thanks so much.
Thanks very much.
Coming up, Hot Picks. We will zero in on 3 plays in life sciences right after this. Stay with us. It's time now for Hot Picks, and today we are looking at 3 life sciences plays our next guest says have strong growth outlook, from oncology diagnostics to tools and medical manufacturing. So let's bring in Dan Brennan, Senior Analyst at TD Cowen. It's great to have you join us.
Great, thanks for having me.
Let's get right to it. Your first pick is Guardant Health. So tell us more about what this company actually does and why you like it.
Sure, so Guardant's a leader in blood-based cancer testing. They were formed, call it 15 years ago, and their motto is blood first. So detecting cancer, historically was done under a microscope, looking at tissues. That is quickly migrating towards looking at, molecular profiles that several of, these big CLIA labs conduct testing for. Guardant's methodology has always been to look at blood first, which, you can imagine the tissue is the gold standard. To find these cancer signals in blood is not easy, but over the last, 15 years, they've really optimized their strategy. They've benefited from the reduction in costs, and they've really seen tremendous growth because of this. Their main market is kind of late-stage cancer testing. Medicare started covering what they call these, comprehensive genomic profiling tests back, call it in 2018, and Guardant was a leader there. And now they moved into a couple other areas. Minimal residual disease is, detecting cancer earlier, stage, call it stage 2 or stage 3. Rather than wait for it to show up on a scan, you kind of find it in the blood first. And now they moved into healthy screening as well. They have an FDA-approved blood test that'll compete with colonoscopy and Cologuard. And they're also moving into broad-based multi-cancer screening. So they cover kind of the 3 continuums, if you will. in cancer. The stock did terrific last year. It's pulled back this year, but we think it's a really good opportunity at these levels.
Really important work, too. Okay, next up is Caris Life Sciences. Tell us more about this company.
Sure. So Caris is in kind of a similar area as Guardant. It was formed back 2008 by David Halpert. And, Caris has really been situated more in that late-stage cancer testing area. So they're one of Guardant's key competitors. And, they're the leader in tissue testing. They have a blood test as well. They're a little bit behind in terms of, their market development there, but it's growing quickly. And they're also moving into some of these same areas that Guardant in the minimal residual disease and also multi-cancer screening. But to date, truly tissue makes up the predominant area of their business. And, they were able to secure a really favorable rate given their approach is a little more comprehensive than other players. So they got a really attractive rate that drove a lot of profitability with that higher price. So they're actually a profitable company today. And we think their pipeline is really not getting the credit it deserves. The stock's down a lot versus Guardant, which almost tripled last year. Caris' stock is down last year and this year. And we think the market is just kind of not really recognizing the value of their tissue testing franchise, B, the durability of their price, C, their pipeline benefit, and D, we think, the company is looking to, expand their sales force to drive more growth. And as well, they're taking a differentiated approach to multi-cancer screening, going after really deep sequencing to provide the highest value. And while that might take more time, we think they're setting themselves up really to be a winner in the future.
Last up is Thermo Fisher Scientific. If you want to go through kind of what this company does as well and why this is one of your picks.
Sure. So Thermo is a global leader in the life science tools industry. So that it's a wonderful business model, kind of razor blade. Themselves and their key peers, if you will. They sell instruments that go to a variety of different end markets, but pharma is the biggest. But also academic labs. Think of big centers around the world. Also, they go into kind of applied markets like food testing, environmental testing. They go into diagnostics. But the beauty of their business model is there's a commonality to their platforms, looking to kind of identify different matrices could be in food, could be in tissue, could be in what have you, and then kind of identify and then separate and identify so that they can detect the signal that's in there. So a lot of their products go to like R&D, which is probably one of their biggest end markets with pharmaceutical end markets, but also, as I mentioned, diagnostics. And the stock has been a terrific performer over the last 15, 20 years. But over the last 3 or 4 years, coming out of COVID, they were such a beneficiary along with peers that you had low interest rates, pharma was spending excessive amounts of money, biotech capital creation, created really tough comps. So the last 3 years have been difficult as they've kind of climbed themselves out of like this tough comp period, and growth has been decelerating. But we think we're at a point right now in 2026 where growth has bottomed out, demand is starting to pick up. We think sentiment is still really mixed because the growth acceleration hasn't happened yet. But I think you're getting an opportune time now to get a market leader at a depressed valuation where growth's beginning to accelerate. You think you buy it here before you see that acceleration occur.
Okay, so interesting. We're out of time, so we'll have to leave it there, though. Dan Brennan, Senior Analyst at TD Cowen. Appreciate you joining us. Thanks so much. Coming up, we will tell you about the Wall Street firm that has flown under the radar but is bringing in stunning revenues from high-frequency trading. More on that after the break. High-frequency trading has transformed Wall Street into a world of algorithms. No firm captures the digital upheaval quite like Jane Street. Many are wondering what's behind its unprecedented success. This week's Bloomberg Doc takes a closer look at that.
Today, volatility is everywhere.
Stocks rally as the S&P recoups its wartime losses.
Market may be trying to figure out if they should listen to good cop or bad cop.
Certainly that's going to have an impact on global growth.
In the middle of all this, some players are reaping huge rewards. Can you guess who?
They're tech savants, highly quantitative, pretty secretive, smart, innovative. They're best in class at what they do, and they're sitting at the top of the totem pole of all the Wall Street firms.
So who are we talking about?
Jane Street.
Jane Street.
Jane Street.
Jane Street.
Okay, but why are they such a big deal? Well, the firm just made a record-setting haul, over $39 billion in 2025, outpacing the big banks and rivals.
The firm is generating billions of dollars. The pace at which it is doing that is unlike anything that I think people anticipated would even happen.
Even 5 years ago, it would have been unthinkable to paint a scenario where Jane Street would have pulled in more trading revenue than the biggest players on Wall Street.
Money making at this pace has raised concerns that firms like Jane Street have an unfair advantage.
The high-frequency trading segment is under scrutiny after SEBI accused Jane Street Group of manipulating stock and derivatives markets, a claim the U.S. trading giant denies.
This unwanted attention is mounting and threatens to reveal more secrets.
Jane Street's combined the world of poker and the concept of solving problems really, really well.
So how long can Jane Street stay under the radar while holding the best cards on Wall Street? Once upon a time, Wall Street was like this. But the stock market has changed.
Imagine a high-speed game of buy and sell happening on computers all over the world every second.
A combination of innovation and a lot of money moving around very rapidly.
A human blinks their eye in about 400 milliseconds. In about that same time, a high-frequency trading computer can execute hundreds, if not thousands, of trades. That is the kind of tech edge we're talking about. Is not just identifying the right price, but being able to get there before anyone else to execute that trade.
Jane Street is the middleman. You can think of the apps Robinhood, Schwab, and the ability to buy a share of Apple. You don't know it necessarily, but there are players out there helping facilitate that order.
We have seen an explosion in the type of ways that you could trade any financial instrument. It could just be a plain vanilla stock. It could be a derivative tied to the stock. As these products get traded in different formats and in different geographies, there is always going to be a little bit of price inefficiency.
Price inefficiency means differences. By buying a bunch of something where prices are low and selling it where prices are high, you can profit from the difference. It's a process called arbitrage. And by doing this over and over in milliseconds, Jane Street is making billions. Increasingly, the firm has been holding some positions for hours, days, maybe even weeks. But its matching of buyers to sellers is why Jane Street and firms like it are called market makers. Their role injects cash into the system, aka creating liquidity.
Liquidity is money, and it's very important, particularly when an issuer like JP Morgan is launching a new strategy. The early days of an ETF are very important to provide more liquidity, and that encourages investors to come in and out of ETFs.
ETFs, or exchange-traded funds, are like a basket of assets that trade as one package. They're often cheaper than other investment products, helping more people get a piece of the pie.
20 years ago, I ran a big portion of JP Morgan Asset Management. I had heard of Jane Street, but I had no clue that they were an important part of the ecosystem. And that was really a reflection of the fact that ETFs were a small piece of the business at that point.
Jane Street's place in this ecosystem has paid off as the popularity of ETFs have exploded. More are coming to market every year. The money flowing into them keeps growing, and the amount they're trading is pushing $60 trillion.
Jane Street, I think, very early on saw an opportunity to distinguish itself around solving for the complexity of ETF market making at a time where other banks were much slower to put resources into that.
It's worth stopping to appreciate the sheer amount of data being processed here. ETFs are made of dozens, sometimes hundreds, and even thousands of individual securities, and their pricing needs to reflect these underlying securities. Designing the rules or algorithms that enable that pricing requires serious chops, and Jane Street employees have them.
The culture of Jane Street is one of puzzle-solving, very mathematical, quantitative professionals.
This has become a very desirable place for smart people to go work at.
Jane Street's roughly 3,500 employees split amongst themselves $9.4 billion in compensation in 2025.
That's a lot of money to go around.
I've been to every firm on Wall Street in the financial industry, and I've never stepped foot on Jane Street's trading floor. I would love to kind of talk a lot about Jane Street's technology, but I can say this, nobody knows anything about Jane Street's technology that doesn't work there.
Maintaining a low profile helps Jane Street protect its secrets. The company declined to comment for this video.
The interesting thing about Jane Street is, to the outside world, there is no designated leader. It says it's a flat organization. Of the 4 founding members, the only one who's left behind is Rob Granieri.
Granieri is a bit of an unconventional character on Wall Street. He's a Burning Man regular and owns a casino in Mississippi where a John Travolta movie was filmed. And according to his lawyer, his longtime support of human rights is what prompted him to get duped into funding an alleged coup against the government of South Sudan. Even finding photos of Granieri is hard, adding to the firm's mystique.
If you think about it, the only reason a wider audience even started hearing about Jane Street was because it was ID'd as the launchpad of Sam Bankman-Fried, the crypto wunderkind who flamed out spectacularly.
Connections to the failed crypto exchange FTX keeps nipping at Jane Street's heels, and the publicity threatens to further crack the firm's shell. But it's a very public regulatory matter in India that's shed the most light into Jane Street's inner workings.
It all started when 2 of their traders were jumping ship to a rival firm. They were worried some of their proprietary trading strategies would be used at Millennium, where those 2 traders were going, and they sued those 2 traders. That legal spat, of course, caught the attention of everyone on Wall Street.
The case involving Jane Street's former employees was settled, but the probe into Jane Street's India operation continues.
India's option market has been growing really in the last few years. The regulators in India looked at Jane Street's activity and essentially they considered it manipulative in the way that they were able to influence the way that prices were moving to their benefit. Now, Jane Street, in their defense, has said that the way that they were trading and the market movement, they were providing a service.
The problem for Jane Street is that the India probe has meant that there are just a lot more eyeballs looking at what they do, how they do it, and how much money they're making.
Bloomberg has learned that China is examining how Jane Street Group participates in its $859 billion ETF market.
So what is a problem in India today could expand into a headache in other markets.
One issue for regulators is that while market volatility can be dangerous for everyday people and their finances, many in the industry directly benefit.
The way markets have performed, the absolute rally that we've seen in the US and elsewhere, the fact that it has attracted a retail investor base like never before, that has meant that people in the middle of the buy and sell orders will just have a successful run, and Jane Street is certainly reaping the benefits of that.
Okay, that wraps up this edition of The Open. Thanks so much for watching. Morning Markets is up next with Roger Peterson. Stay with us.